to Let's Talk Real Estate Investing. In this podcast, I bring you insights, experiences, and lessons from real estate investing professionals at all stages of their journey, along with industry experts who provide essential services to you to help you to succeed. Our goal is to empower you with the knowledge and strategies needed to build a personalized real estate investing plan that aligns with your unique goals. If you enjoyed this episode, please hit that like button and subscribe to my channel. It helps me to continue to share valuable content with you. My name is Debbie Balfour, and I'm a real estate investing professional and a real estate investing success coach. I help IT professionals build true financial security by unlocking 60 to 100K in additional income within 12 months through my personalized investor strategy framework. Real estate investing isn't a one-size-fits-all. Your strategy should be unique as you are. Thank you so much. Today, my special guest is someone I deeply respect, and you're going to want to take notes for this. Our special guest today is Benoit Sorel. Benoit is a financial risk and project management expert whose career spans banking, mining, and multi-billion dollars infrastructure. He was even the CEO of Vancouver, Canada Line, $2 billion transit project. Can you imagine that? $2 billion. Now he's a full-time real estate investor, and he specializes in multifamily acquisitions, CMHC financing, and capital stack optimization. And he's built his reputation as a trusted partner in this space. Really excited to be speaking to him. We'll be speaking to Benoit about how to scale from 0 to 100 million in 2 years using the multifamily asset class. Welcome to the show, Benoit. Tell us a little bit more about yourself. How did you get into real estate investing? And tell us a bit about your journey there.
So real estate has been a passion. First, thank you for having me today. I'm flattered, and thanks for the introduction. My journey, like you explained, I come from different steps in my career. Corporate life first, which was, first part was financial engineering. I was working in trading room, and thanks to the first financial crisis in 2000, I said first, for me at least, in 2000, the new tech bubble, I transitioned to risk management, but at that time there was no system, no banking, regulatory. Basel Accord was emerging, and so I had to develop a lot of system to support more risk management, essentially in financial risk management. First life was that I was a consultant. I was the first financial risk manager of KPMG. I worked with McKinsey. I worked with different top firms. Essentially, I was advising, specialized in derivatives for treasury departments. I was also validating independently the books of advanced derivative products for Caisse des Dépôts and also pension funds like that. That was my first life. Then the second life, I worked with still in finance. Transition to Alcan, which is now not regulatory, but more strategic risk management. So I was doing a lot of quantitative analysis, but supporting decision-making process for the board, for the C-suite across the company, which was making 200 billion of revenues per year. And I was in charge of modeling every downside risk of every investment of 50 million and up. I was involved in every strategic decisions in the company, which was amazing. Fast forward, I transitioned to SNC Lavalin. So that's my second life, which is project management. I studied as a project risk manager, which is another completely different field, but part of the same spectrum of risk management. There's financial risk management, and essentially it's finance people. And project risk management, and I was lucky enough to not be an engineer and still develop an expertise in that field. I know the whole spectrum of risk management, whether it is financial or non-financial. and applied that to decision making and also to mega projects. I joined Alcan in mining first. I worked all over the world on mega projects. The biggest project was $12 billion, and that also was very, very far from where I started. And I said, "Whoa, I need to find something that reconcile both experience." And this is where I end up in Vancouver because I was the CEO of the Canada Line, which is a PPP project, private public partnership. And it was also a $2 billion transit project owned by Alcan and two pension funds. This is now finance and also project management flavor, essentially. And that was the end of my corporate life. So in parallel, evening and weekends, like all of us do, I like real estate. I invested, small scale first, on condo flips in Montreal. My first one was probably in 2005, I think. And did one after the second and more, and one after another are always more complicated, or you needed to think out of the box. I converted a morgue. There was an article on me of those projects, very unusual, let's say, in Montreal, converting from flipping condos essentially. I started to scale and do a bigger flip, which is a condo conversion, buying some mid-size apartment rentals, which needed, in fact, some TLC, and renovated and started to undertake the conversion into condos and sell per unit. I've done that a few strategies in Montreal, and after fast forward, I arrived in Vancouver. I purchased again. That was a focus on my career for some time, and then after I started to reinvest because I love real estate. I did my first big value add again in Vancouver. Was also in a magazine for best design and renovation. I was part of the Georgia Award for best kitchen, the best kitchen, and my house here, which is a huge problem, which a huge challenge. It took 3 years to accomplish, but also was also identified in magazine. So yeah, essentially the evening and weekend first, and then after the Canada Line, which was the change for me of transitioning from corporate life to entrepreneurial endeavors or goals, which I had for a long time. I always wanted to scale in real estate, but never really understood how to turn from a hobby or a passion into a business, which is very, very different, obviously. It took me years. It took me 15 years to understand, to crack the code. And how to go from, and this is key, this is what between doing a flip, which is monetizing the lift, the value add that you provide, but you have to sell in order to cash in the profit, or the profit the first appreciation that you were able to do, versus to what I'm doing now, which is refinancing. Not only you create the same forced appreciation, same process, but instead of selling, you just refinance. And this is now having another flavor of refinancing, and keep it and be able to build a portfolio. So this is really the essence of when I got this concept, and be able to be nimble in financing from A lenders to private lenders, from let's say 0% to 15%. Those are the spectrum of what you have to play with when you do those value add or other type of strategies. This is what changed completely the direction. So I worked after the Canada Line with a real estate developer for some time, just to also understand what is beyond the project, what is the other aspects, which is marketing and money raise, which I didn't know. I work with them as a partner on few startup projects, so new projects, mid-size, 200 unit development in Langford and Kelowna. And this gave me, in fact, the full understanding. When I also understood how to refinance and play with that and build portfolio, I said, okay, let's create create my company, which I did 5 years ago, and focus only on the value add, which is the summary of all of this. So the value add is especially if you do in multifamily apartment buildings, it has to be minimum 5 units. In order to qualify for CMHC, it has to be rental. When you do that, then you can you can access incredible financing terms, which are available now for any operators, for new buyers, also for more seasoned people who are already a portfolio but don't know how to gravitate with this new program. So I focus really on CMHC and just refine the process to understand it perfectly, whether it is through acquisition or even new construction. And this is what I do now. So I do within few, I built, in fact, an investment, a private equity real estate investment firm, essentially, because you cannot use your own money infinitely. At some point, you get tapped. So what do? This is the difference between investing evening and weekend and transitioning to a business. It turned into a private equity firm, essentially, raising capital, compliance, structuring new, very advanced structures in order to be compliant and de-risk the investors and so on and grow like that. And now add the financing aspect, which is to force the appreciation, refinance and recycle, repay the investors, get to a new concept that also was very esoteric, is infinite returns.
Okay, what does that mean?
Infinite returns this is what excited me at that time and makes everything change. Infinite returns is when you have skin in the game. So you invest, you put, traditionally, on a conventional loan, you get 70% mortgage, so, or if you're lucky, it's 80%, which you can get now, even on the residential. So when I say residential, it's anything that is 1 to 4 units, and 5 and up is commercial, or at least you can get commercial financing. So when you get when you force the appreciation, essentially, and you be able to refinance, so you start with 30% down. Let's say we were talking about 20% down. So equity, your contribution, your cash down, do some renovation, for example, brings the value from 100 to 200, and refinance at the new value, which is again, for example, 80% of the value. And of the 200 as opposed to 80% of the 100. And this forced appreciation that you're able to capture helps you to repay your initial investment. So you recoup your 20 plus your investment on the renovation, which end up being in an ideal situation, no skin in the game, and you still have kept the asset. So now you have recycled your initial investment. No, you have kept the asset 100%. And you have now back your capital, and sometimes even more than what you invested initially. And now you can scale. You can build your portfolio and grow like that. When you receive passive income on an investment like that, for example, dividends or refinancing proceeds, but when you have zero skin in the game, this is 1 divided by 0 equal to infinite, which means it's an infinite returns.
There we go. And now you own the asset, unlike flipping where the asset is gone. You flipped it to yourself.
Yeah, I would say flip it to yourself. Yes, exactly. So in 2 years, my partners and I, so we built an operation in BC, Alberta, Nova Scotia, New Brunswick. I think probably another province. We acquired 400 units and we have 200 units under construction also. So different locations.
Right. Let's talk about investors. How are you getting that down payment part of it?
So, like I said, it's easier when you start with your own capital, obviously, because then you don't have to focus. You can act immediately. You can put your down payment.
So you're using your own money in there?
The low-hanging fruit is use your own money.
Okay.
If you can, then at some point, if you're still in the process with your first property and you don't have any more savings or access to capital, then you have to look for third party. Now it's called other people's money. And this is why we talked about the private equity, because
You have that private equity group that's where you're raising capital in there. How are you getting people to know about that private equity firm? Do you have an exempt market dealer that's going out?
So we've been using a lot of our network, people in our network. So thanks to when you work with other people, when your team, when you work within a team, then you can at least share the work. And so it's very difficult to do the money raise, the operation, the financing, and all that. There's so many aspects, on the execution of the project. So thanks God, I had some great partners, in East Coast in BC, and we are sharing the money raise aspect. So they have their own network, or when we don't, then we can communicate use some research investment groups where we can start to share information and essentially do some marketing, but within kind of an extended family,
Right.
people who know each other, so that we can share this is how we've met, by the way. And continue on that direction. So then after, when you start to grow, you aspire to larger project or more capital to raise, then of course there's many other strategies. EMDs I've tried, but I'm not too fan of this approach, because the market is also very competitive now at the moment, and dealing representative will tend to favor the simplest projects as opposed to the one that probably, yeah. So the more complicated, the more difficult it is to sell. And if you rely on other people to do the raise, then it's more complicated. Then the result is mitigated, which is why I'd rather do it myself, because as an issuer, you can do it. And so we have better results.
Are you using registered funds? Are you using cash? Do you need accredited? Are you working with non-accredited?
We've used very different strategies. It all depends if you control the schedule, and I say controlling the schedule means I'm always in an environment of value add. So BER or value add, call it like that. Value add is you need capital for closing, acquire the property, but there's a lot of problems traditionally, which require some more capital in order to reposition and get to a stabilized state. The question is, how long does it take to achieve that? And if you have highly distressed, but also or some area that you can correct very quickly, and that will bring you to the value that you need in order to refinance and repay your investors the target that you set. So, for example, if you can do 50% within 6 months, people are ecstatic. Or can you do that within 12 months and sometimes 5 years? Because if you have to use CMHC going in, then you're stuck. So, bottom line, it all depends the strategy that you approach to acquire the property, and do you finance all cash? Ideal, because then you have the flexibility to finance within the months. If you need a debt, then is it conventional or is it CMHC? If it's conventional or bridge, then it's high interest, but it's also short term, which means you need to control the schedule. I go back to that. So if you control, let's say, if you can execute within 12 months or less, then it's worth doing some. You can do fixed interest type of investments, and even paying a high interest rate is a win-win for everyone. So you pay high interest for the investors. They also know they are not stuck for 5 years. Sometimes they get nervous when they invested too long. So that brings the value on both ends. And for us, we retain 100% of the interest. We maintain the risk, and the commitment is to repay the obligation, is to distribute the performance to the investors. So again, the first one would be private lending, or first strategy would be private lending or preferred returns. If it's debt, it would be private lending. If it's equity, it would be preferred returns, and also can be the same format, but under different acquisition structure. Is it shareholder or LPGP? So this is where we now expand on how it is acquired. The structure is important. So
Mhm.
you ask for if it's registered or not, it has to be equity. Now, is it registered? Do you have a mutual fund trust, MFT, in order to be accept registered funds? So we've done that also, very expensive. Yeah, obviously it's more liquid, it's better, but I would say an MFT now post-mortem, because as soon as you start, you cannot, there's not only the initiation cost, but there's also the yearly cost and the admin and the compliance, which is very heavy as well.
Yes.
So if you ask me my preference, I would go with accredited or very high net worth individuals, buy cash and be very, very aggressive on the
So your first priority is to find accredited investors. Cash.
accredited is good,
Mhm.
but yeah, in my situation, and I'm taking the opportunity to say if I had one strategy to push, it would be a very high net worth or family office, and have a pool of large capital, 5 to 10 million, buy cash properties, do the forced appreciation, and refinance very quickly. So now you have the best strategy because not only the cost is lean and the return is very quick. So as opposed to when we work like I've been working, like everybody, you're constrained on capital. So you have to be smart, and how to be smart and scale, you need to focus on the debt. Optimize the debt first. This is what we said earlier, optimizing the capital stack. Optimizing the capital stack, which is debt and equity on both ends. But if you maximize the debt, then obviously there's very little equity left. So now you have optimized your need to raise capital because you focus on optimizing the debt. And this is what CMHC offers. CMHC can give you up to 95% loan to value, which is amazing. Percent, obviously, it's not a done deal. It's not easy to achieve, but it is possible. And I've done it very often. Even the highest leverage that I achieved in one acquisition that we had in the past, which allowed us to buy our biggest project, was 99% loan to value.
Wow.
So you need to have a risk manager in your team.
Definitely. You have to have all your ducks in a row in order to get that one.
Exactly.
That sounds great. Tell me a bit about what are some things that were eye openers that you've hit in your journey that you've learned from, but that you would like to say for others to be aware of.
Like I said, I think once you spend time with understanding the CMHC financing, then you realize it is beneficial for new buyers because it is complicated to put it in place, but it's also simplifying once you can execute, comply with the minimum requirement. You can buy and minimize the equity requirement. So you may even be able to buy it yourself, if you have a set of capital, but if it's not optimal, then you will buy a house. But if you instead of buying a house, you can buy a 10 or 20 plex. I'd rather buy a 20 plex myself.
And rent your home.
And rent the home or move in a 20 plex, So I will go back to first thing is to understand really CMHC programs because they are the best in the world today. There's nothing else, nothing better.
However, we were talking about CMHC, and depending on who you get, they interpret things a little bit different, right? So, what are some of the gotchas with CMHC that people should be aware of that it's not a done deal?
So first, yeah, it's not a done deal, but first you need to be optimistic. So I think it's a done. I wouldn't say a done deal, but you will be able to. First off, I like the half full type of glass. So to me, first positive thing, it's CMHC has the obligation to provide funding to any projects. So that's a very big statement, which means if you find a project in a Nunavut, it will be financed by CMHC. They have the obligation to do it. It doesn't mean it's easy to do it, but it is an obligation to offer funding to everyone in Canada. Just that is incredible. The second is they set also the guideline. Like I said, it's a 95% loan to value, 50 years amortization. There's no 50 years. I mean, you're British, so there is the last program that in my was taught at school 25 years ago, and that was brought from UK. I've not seen this since anywhere. So Canada having this in place, obviously the US has copied it a bit, but it's not as rigorous as it is here. So yeah, the lesson is it is great. It's a great program. The best is to have a coach or someone a partner, someone who is knowledgeable on the program, so that you can gravitate and prevent the mistakes. So that's also a big aspect. But you need to have a strong team. So as I go back to the team, but it's not only the person, the mentor or the partner, but it go beyond. After, your mortgage broker has to be top notch, has to be commercial and really knowledgeable. Everyone says they can do it, but have they really done it?
So you want a history. You want to hear
History, a strong
history
team.
of that
You
person.
need to have a very strong team, and this is not done. The problem is one mistake can cost your house. This is a problem. So it is very important to be risk conscious, and again build a team, a strong team first, so that you prevent mistakes, that people can foresee in advance, or I've gone through, unfortunately, before you.
Tell me a bit about your history doing this, some of the returns that you have given to your investors, and what was the time frame?
So usually it's a part of the secret sauce, but I'm happy to share a bit. The private, like I go back to the different type of investment opportunity. So there's private lending. Private lending is a debt instrument. This instrument is taxed on income. So that means every additional dollar that you add on your overall revenues that you earn through salary or day job and so on, anything on top of that is taxed, because you're most likely above on the bracket of 50% up, so would be taxed 50%. So because it's taxed on income. As a result, you need to think also tax after tax type of returns, and so private lending, I would say 15% is a strong.
And is that something that you give to your private lenders? They get 15%.
Yes, I offer that because it has to make sense for it's. The goal is not to shop. We want to build a relationship. It's better to give the best you can give to your investors, so that they're happy and we can focus on the project. Money raised is just a part of the project. So if we can expedite that and give the best, so to our investors, at least the trust is there, and we don't lose. I don't want to spend time to be too salesy on the money raised. I give the best I can, and that's it. So this is for the debt. For the pref. Pref is tax on the capital gain, preferred returns. Which is either LP units or equity instruments. It's taxed on capital gain. So it changed, as we know. I think it's back to 50%. Is it 50% or 67? So it is still better than preferred return, than private lending, because it's not 100% that is income. It's only 67% in that case. And so you can give a little less, So traditionally with the pref would be in a range of 10 to 12, something like that, in this range. Then after there's the equity, and so the equity is because I don't do buy and hold. I'm an active manager, so I focus only on the forced appreciation, on the value add strategy, because the goal is to create up to 100%, over 5 years, which give a 20% return of capital. The goal is to return the capital at year 5 in worst case scenario.
Right.
If I had to start with CMHC, because the capital is constrained, which has been our experience last year at least, we change the time frame to 5 years, which is the minimum cycle for CMHC. So you acquired with less equity, but you're stuck with 5 years to refinance, to access the capital after.
So then your investors are paid out after the 5 years.
We refinance it.
But then you own, so you've paid out your investors and now you own that asset.
We own the asset together, but the goal is to, like you said, you asked me the performance. So my target is to return 100% over a period of 5 years.
Right.
If we can, and this is the point, this is the worst case when you start with 5 years because of CMHC. You have to give a strong performance, and 100% means 20% of annualized return. This also is solid. But at that time, they have 100%. You have not paid them out. They can keep the asset, and they have no skin in the game. This is where we talked about the infinite return.
Right. So your investors stay in with you. You pay them back 100%.
That's one scenario. But in this scenario where we buy and keep for some another cycle of 5 years, for example, then yes, infinite return. They have kept all their interest. And they have no skin in the game because we targeted 100% over a period of 5 years, which is 20% annualized. That's the scenario. So now, if you have unlimited access to capital, this is what I was saying. Now you buy cash, you refinance, you renovate, you do all the first appreciation, which is instead of doing it over a period of 5 years because you were stuck no matter what with the CMHC schedule timeline. Now you can. It's all dependent on the building itself. Is it fully vacant? Are you adding are you adding a floor? Are you developing the basement? Can you build another building on the back? Can you use the mechanical room and create some value where there was none before? And therefore you can create also, you're not disruptive in that case, so you can go fast and also create the value very quickly. If you do that 6 months, you can deliver the value that you have targeted and refinance very much quicker. So I say 6 months, but 12 months, so something like that,
You've got these new developments. You've got these 2 projects you're working on. Are you looking for capital for these developments?
Thank you for asking. So yes, we're always looking for capital, so it's not something that there's always project in the pipeline. And so the 2 strategies that I push, is the one we just discussed, which is the value add. And so the market is a bit softened, at least for sellers, which is a great time for buyers. So the cap rate are increasing a bit, interest rates are reducing. So the timing is amazing for buying. And so if you now can find some good projects which are distressed and potential for fast appreciation, this is the best. First strategy that I've already identified a few projects like that in BC, in Lower Mainland, because we used to not be able to buy Vancouver. Vancouver was more like an asset appreciation strategy. Now it has become cash flow again because the cap rate has increased. So I'm very bullish with Vancouver, Metro, especially if you focus on value add. So I'm looking for capital for that because I have a few properties that I've identified. So I'd love to build a pool. And the second is obviously the second strategy, which I've been pushing the last 2 years, is building new. So we have I have a 70 unit in Port Alberni that is BP ready. I'm at the last stretch. And there is another project, which is 53 townhouse development in Langford. So this one, and I'm raising capital for the soft cost, essentially, to get to first draw, to build, to get to BP, essentially, fund all the consultants, the tax, the permit, and so on, so that we can get to the checkbox for the financing application. And get the loan approved for construction. So this is what I'm also raising capital for.
Just to clarify, when Benoit said BP, he means building permit ready. What are you looking for investors right now? Is it accredited, non-accredited? What's the minimum buy-in?
Accredited is the starting point because friends and family is overused, and the Securities Commission doesn't like it. And you need and whatever capital you take, you need to really demonstrate their friends and family and business associates. So I tend to focus on the true accredited investors. And because it's straightforward, they know they've done this in the past, and they also qualify. So this is the target, obviously. And what means accredited? It's okay for the last 2 years. So you need to provide your NOA to demonstrate that you earned $200,000 the last 2 years with your income. If you don't make 200 alone, but you are a spouse, or you can combine income of a 100K together. But again, the last 2 years have to be proven. So that's one way to demonstrate you're accredited. The second is you have $1 million of liquid assets, which you can also demonstrate you're accredited. And the third one is you have $5 million of net worth of in real estate.
Yeah. Okay. And what's the minimum that you're looking for from your for investors?
I would say we are flexible. So because building a relationship for between an issuer and an investor takes time, and trust is earned. I would say minimum be 50K, just even though the target is much more.
Right. Okay.
But for someone who really wants to try and see if we walk the talk, essentially, then a smaller tickets, as long as they are accredited, is definitely welcome.
And you, like we've talked about, you've got quite a history, and for investing in real estate, this is a must that I think a lot of people haven't done and has gotten burnt, is that they've worked with people who are now getting into the game. This is their first development, and then they don't have a track record of doing these kind of things, of paying back their investors. But as we've just discussed, Benoit has that track record. So you can discuss that with him. He can show you what they've done in the past, how quickly they've paid back. So these are things that anyone investing in real estate should be, interested in, not just the projected numbers, but the person, that part of their credibility is, have they done this in the past? What was the returns that people receive? Did they receive it on time? What was those time period where they got back their money? That's the important things to find out.
Exactly.
Yeah, because we've had a lot of people who are losing their life savings as a result of investing in with others that haven't had this track record, and they've gone bankrupt. Their developments have failed.
It's a very, 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 very good business, but also very risky at the same time. So
Very risky.
you have to have processes and be cautious. And as an investor, you need to ask, you need to know what to ask also at the same time. But like you said, track record and reputation and experience is the starting point.
So, Benoit, you do consulting. Tell me a bit about what type of consulting you do.
So when money raise is difficult, I want to remain active and in the market, and also at the same time I want to share the knowledge, with that I acquired the last few years. And so I do help investors either for new acquisitions, also coming by themselves is very difficult, so you don't know if you will rely on the team, but if you don't know if you have the A team, so mortgage brokers will gravitate, and the problem is you get the problem at the last minute. You can make an offer, you think everything is fine, and it's only at the last moment when you get to closing, when you get the underwriting, that you start to have comments from CMHC, and if it doesn't pass, you already raised your capital. If it's not your own money, which is even worse, and now you have invested capital of third party, and you cannot close. When you cannot close, this is the worst. So, like I said, advising first-time buyers in multifamily, obviously, is to gravitate, help them make the offer, understand, making sure that they don't overpay. So building a process for that. And also getting CMHC financing is difficult, because now to get the 50 years amortization and the 95% loan to value, that means you need to give social outcome. Social outcome has become the key factor of success for those projects. Is it affordability? A lot of projects will never fly or pan out with affordability. So you can, if you're lucky, but you're stuck for 10 years. So you really need to now focus on more technical aspect, which is accessibility and energy. It used to be 100 points, which means 50 years or 95% loan to value immediately with 40% energy savings. By the way, for 40% energy saving is not easy to achieve. Now it's half of the points. So just that you need to do the extra mile again. You just get 50 points for delivering 40%. So now this is a minimum requirement in order to just get 85% loan to value and 40 years amortization, but 1.1 DSCR. This is what you get for 50 points. So you need to do more. You need to get an additional 20 points, if at least, in order to get 45 years, 95% loan to value, and still 1.1 DSCR. So again, it becomes technical, but this is key. All what I just said is really what
Energy, affordability, and then the third one was
affordability, energy, and access. So very difficult also to implement. But again, like I said, it's all about who you know and have the right engineers in your team in order to deliver. So first support is obviously help new buyers who wants to get into multifamilies. This is what I do. The other type of same consulting, but this time for operators who already own a multifamily but have not optimized their portfolio. So a lot of people have the luck to have purchased some time ago and have built a lot of equity, and say, okay, what do we do? What can we do with this untapped equity? So if you refinance with conventional, you will extract a little bit, but not much. And I do that with very seasoned investors. So it's not. It is really a new field, and to be nimble and understand every bit of CMHC takes a lot of time. So even though you could have invested for a long time, the question is, if you have apartment buildings of 5 units or more with some equity, because you know that the value is X, 50% loan to value, for example, what do you do? So, and this is where it becomes the same type of strategy, but applied, to an asset that you already own. So what strategy do we need to put in order to extract some capital? So this is extracting capital. And the second also strategy for those owners, sometimes they inherited of assets that are distressed, and it become like a big source of stress. Do we sell, get rid of it because it is really toxic and we don't know what to do with it? Then this is where I come along. Give a independent review, provide some strategic planning to reposition the asset, help them stabilize and extract the capital if possible. Therefore, it become hands off again. It become passive again, and you can hand it over back to the property manager, who will just manage the operation, become truly passive, and now you enjoy the passive income. But having an asset that is not performing, and you get just problem with the tenants, with the operation, leaky, whatever, it is never ending. So it can be very overwhelming, and you may be tempted to sell, which is not necessarily sometimes the best strategy to do. So this is why I come.
I say this to my clients. You don't always have to be expanding your portfolio to be making money, but look back at what you already have and how can you now create income from what you already have.
Exactly. So just to comment on what you mentioned is also dotted line to what we discussed earlier, is raising capital is difficult. So you may be knowledgeable in real estate, know everything, be very technical, even can deliver all what we discussed. But the money raised, if you don't have capital, there's no project, so which is now the next challenge. So having what you just mentioned is very true. If you have some assets and you don't even think, because you focus on the new acquisition as opposed to pause and optimize your own portfolio, you may be able to extract some capital that will become the down payment for your next acquisition, which will create, and if properly sorted out, if properly selected, will generate again this forced appreciation and recycle your capital, and you will be able to be by yourself grow, which is incredible. And this is the ultimate goal, essentially.
Awesome. This is so exciting. And as I've promised, I hope everybody was making notes, but of course this is recorded. So you can actually on YouTube, if you go down in the description, scroll down, you can take a transcript right from it too. So just a tip for everyone that's out there, and then throw it into ChatGPT, and ChatGPT will create your notes for you. A little bit of technology instructions there for you on how to extract all these wonderful, great bits that Benoit has shared with us. So you have some freebies to
Yeah. So we talked about consulting again. If someone has a project, like just either it is embryonic, or it is really ready to implement. Also, feel free to reach out for. I'm happy to give a free consultation. Whether you want to acquire a property or you have something, a portfolio, and you need I can provide some comments and maybe help you debottleneck. That will be the thing. Happy to do the valuation. When we do this, if this person reach out, I've developed all my tools, to do the valuation and so on. I know exactly what will be the debt with CMHC. So all those processes are done outside. And when we go to market, with the brokers and so on, it's already the appraiser, everybody would be aligned to what I provide. So this is why it may be worth reach out, and it will be my freebie.
So I will share with everyone in the show notes how to reach out to Benoit, how to take advantage of this free offer that he's offering. It's always great to have that second eye, that second opinions. Thanks so much, Benoit. Really appreciate you taking your time out of your busy schedule to be with us.
Thank you, Debbie, for the opportunity. I appreciate it.
From Benoit and Debbie, we're out. Bye, everyone.
Ciao.